get to our first management on the show before we get you an idea for profit coming in from our colleagues at Money Control Pro. Allied Blenders and Distillers. It was a tough quarter for the liquor industry on the whole. The company's revenue was down 7%. Volumes also declined by nearly 12% on a yearly basis. We have Alok Gupta, who's the managing director of the company, joining in now to discuss the numbers in detail. Thanks a lot, Alok, for joining in. When the revenues were down about 7% with volumes declining by 11% as well, you went ahead and showed a sharp improvement in your operational performance. I just wanted to know, in the second quarter, have volumes recovered? And what's your prognosis for margins for this year?
Thank you so much. I think if you look at the Q1 performance on back of the Q4, that was the exit quarter for last financial year, actually the volumes have grown, the revenue has grown. But we compare to the quarter one of last financial year, there's a definite decline. That's largely on back of some consolidation and market prioritization that we have done. So we're quite happy with where we are. And that reflects in our operational performance. As far as Q2 is concerned, I think it's looking good. We are consolidating and we are hopeful for a much stronger quarter.
What is a much stronger quarter? What kind of volumes will you end this year with positive volumes? If yes, by how much? And is Q2 reflective of that?
Well, it's certainly in the year with a double-digit growth over the last year. And the Q2 is reflective of that.
Okay, all right. Hi, Alok. Good morning, and thanks for speaking to us here on CNBC TV18. This is Nigel on this side. Besides the operational performance, I just want to understand about the interest cost. Now, you've done the IPO, the interest cost is likely to come down dramatically. For the first quarter itself, your net profit number has come in at around 11 crores. But your interest cost is around 44 crores. Now, my guess is that if you're going to be virtually debt-free and your debt is going to come down drastically, this interest cost from around this 45 crores will come down as well. So on a quarterly run rate from quarter two onwards, what should it look like? And majority of it will flow through to the PAT, right?
Yeah, that's absolutely right. So as you recall, our IPO was dated on 2nd July. That was post quarter one. So we had the interest costs were no different than what was in the last financial year. As I stated earlier, we expect our interest cost to come down by about 50% in this financial year and only reduce from there on.
So this year, your quarterly run rate should be what, around 30 crores per quarter? 25 to 30 crores?
Maybe a little lower than that. Maybe a little lower than that.
I think half of what you're saying, so around 20 to 25 crores is what we could work with. Is that correct?
I think that would be a fair estimate. That would be a fair estimate. Somewhere a number will be in between as an exit run rate.
All right. And what happens to your margins? Because, you have two levers. One is that your premium products are increasing as a proportion of your sales. Secondly, you are increasing your own captive consumption of ENA as well. But with ENA prices remaining firm, gold or glass on the decline, what are your margins likely to be by the end of this year? Are we looking at, say, 12%, early teens?
From a gross margin point of view, we are seeing early results. We are already seeing about a 300% basis point margin expansion on our entire product portfolio. Back of a greater focus on P&A, greater focus on our luxury portfolio. We are looking at our margins to be early double digit. That's really what we're working towards. But like we mentioned earlier, over the next couple of years, the idea is to get at industry parity.
So industry parity is mid-teens. That happens, say, 3 years from now. Early double digits is 11-12% is this year?
Well, we are hopeful that we should be in that strike range.
So if we draw a glide path 3 years from now, you look at, say, 11-12% this year, 13-14% next year, and 15% plus coming in from FY27.
That is right. A lot of work needs to be done. I think one point that you've already covered is in terms of a consolidation, in terms of captive ENA, our continuous focus on the premium and luxury portfolio, of course, re-engineering some of our cost structure. So a lot of work to be done, but we're in the right track.
So that would mean that you'll start delivering EBITDA for the year of around 750 crores. 15% of around 5,500 crores. Is that an aspiration as of now?
Well, the aspiration is to do better, but that's direction.
That's correct. So FY27 numbers broadly should be this 5,500 crores with 15% margins?
Well, I would say yes. I mean, broadly they're in the strike range again.
All right, broadly they're in the strike range. You briefly mentioned captive ENA sourcing. So what is the proportion right now and how much will it be, say, in the next couple of years?
Well, currently about 30% of what we consume is from our own captive sources and 70% is what we buy. And over the next couple of years, we want to get to to 100% captive ENA in terms of our backward integration program.
And what's the differential between the two when it comes to costs and margin impact?
Well, I would say it should impact gross margin by roughly 250 basis points. And that will flow down straight to EBITDA.
All right. So this 15% margin that you're talking about, it factors in this 100% captive ENA, right?
Absolutely. That's a very, very strategic initiative for us at ABD.
Okay, all right. You're sounding pretty optimistic about business prospects, so cheers to that. But what about your market share? You know, as a percentage of the market, what were you at? What are you at? And where are you headed?
We are currently at about 7% market share. I think by end of the year, we should be looking at least 1.5% market share gain on back of the growth that we have planned through consolidation in the P&A segment, Officer's Choice, Iconic White, and Sterling B7. All three are looking good in the segments that they operate in. The portfolio rollout, the new brand rollout in the luxury segment is looking good. Zoya has started to sort of roll out nationally, and we're looking at rolling out a few more brands in this financial year in the premium and luxury segment. So I think as of now, things are good.
All right. Quickly, just before we let you go, Iconic has been launched in 3 new states, and Zoya as well as a gin that you've launched in Maharashtra. What is the proportion of your revenue that you expect to get from Iconic and Zoya in the next couple of years?
Well, Iconic, we did about 2.2 million cases last year, exiting at about 3 million. As things stand, the Q1 is indicative that we are close to about 4 million cases ARR, and we'll grow from there. So of the total sales that we are planning, I would say about 12-13% sales should come from Iconic alone. Zoya operates in a luxury segment. I think that's a new segment for us, and there it's not about volume, it's about capturing customer imagination and sort of getting a larger share of the bar, if I was to say, through the new rollouts that we have in mind.
Okay, all right, and that's visible because realization per case has well moved up by 3%. As you've been saying, you're focusing more on premiumization. So how much more upside to this number?
Well, we should be exiting the year hopefully close to about 40% gross margin, and it should only get better from there.
All right, Alok, appreciate you joining in. You're sounding confident about business. We'll track all these numbers that you have given. I'll tell you personally, I can tell you that the gin market, it's really picking up steam. Even someone like me who prefers my malt, I often on, particularly when it's a little too hot, look at the gin market as well. Thanks a lot for joining in. Wishing you all the best, and we look forward to hosting you yet again. Well, time to shift